And lastly, for this chapter, we have financial statement changes and, as you'll see in a moment, changes in our adjusting entries for this. So going through each of our financial statements here, not necessarily in order of preparation, just in general. So you'll see there are no changes, statement of retained earnings necessitated because we switched from services to tangible goods. Same thing would be true for the balance sheet, no major changes there. Yes, you will see some additional accounts. You'll have an inventory account. In reality, you also have an account dealing with, because you have to charge customers for sales taxes, so you might have sales taxes payable on your books, but there's not a lot radically happening there. The biggest difference is going to be your income statement. Again, we're going to go from a single step format, which simply means revenue minus expense format, to a multi-step format so that we can illustrate gross margin, or again, gross profit, mean the same thing, which is going to be defined as net sales less cost of goods sold, and also so we can categorize some of our expenses in terms of just generically selling and administrative expenses. All right, now, and also this format will give us the latitude of dealing with, so if we have anything that doesn't deal with our operations, so if we have any non-operating revenue or expenses, and there are a wide variety of these in practice, but we don't deal with too many of them in this class, but anything that's not specifically part of your operations will go below that. So you might have to have a line called income or loss from operations. In other words, so that somebody looking at your income statement can say, okay, this is how the company did if we look at primarily why they're in business, and then below that is either other forms of revenue or expense that ultimately lead to what their net income is, but again, are not specifically part of why they're in business. So that's why we just want to, separate it. All right, and again, so so we already talked a little about interest revenue, interest expense, and in a later chapter, we might talk about gains or losses from selling off fixed assets, which is in chapter 9. Again, those are not part of your operations, but they will affect your net income. So they'll go below that income from operations line. So this example does not refer back to anything in any of the previous parts of the handout / videos for this class. So this is just a fresh example. So the first section that you're going to have is going to be revenue from sales. So you're going to take your balance in your sales account, and you're going to subtract whatever the contras were. In other words, your sales, returns, and allowances, and sales discounts. So in this example, I said returns and allowances were $750, discounts amounted to $250, so $1 million flat. Take the difference, and we get $5 million as the balance in net sales. Okay, and from that, you're going to subtract cost of goods sold, which is just, again, an amount that you have an account for. So in this case, it was $3,150,000. So that led us to our gross profit / gross margin of $1,850,000. So in other words, there's a couple of equations from this format. So there they are. I just referred to them just to recap quickly. So sales minus sales, returns, and allowances will give you net sales. Take that amount in net sales, subtract cost of goods sold, and that'll give you your gross margin or gross profit. Right, so if this is a positive number, which I would hope it is, does that mean automatically you will have a net income? And the answer is no. Because why? You have to determine you have yet to determine the impact on the company's net income, other expenses, right? You're just saying this is what happened after our first big giant expense. Our primary expense has been taken into account. This is where it stands. Obviously, if this number was negative, you're probably not going to have a net income. That would be a pretty hard thing to achieve if you're actually selling your goods for less than you paid for them. So, which is, by the way, would be a bad business, practice in general. It'd be a bad business plan. I plan to sell things for less than I paid for them is not a good way to go. Right, so everything else we'll look at in this, again, section that just deals with our operations is operating expenses. So I just put them in two basic categories: selling expenses, and sometimes that second category is called general and administrative expenses, which is just anything that doesn't fit the selling function, we'll just throw in there. Now, from a practical standpoint, if you're an investor in a company, those designations usually don't mean much. It's usually internally, like when we're talking about how much cost is being generated by a department. It's probably more germane there than it is necessarily on the income statement from a financial standard, user standpoint, but sometimes you'll see it demonstrated like that anyways. All right, so again, selling expense means what? just like it sounds, like cost of let's say the salaries for your sales force. You have a sales force. Cost of anybody that works in a brick and mortar storefront, for example, we included there. And obviously, like any supplies used in the selling function and so on. So that would be included. Anything we can reasonably attribute to the selling function will go there. So in this example, that added to 645. Everything that isn't selling goes in our catch-all, so our administrative expense catch-all. Now, some categories that you might think, well, maybe we could allocate it to the selling function, we usually say, no, we're going to look at that strictly as administration. For example, insurance. Usually we just say insurance. There's no selling function involved in that. Insurance is strictly an administrative cost, so it will all go there. So again, administrative expenses would include everything that isn't included in the selling function. So if we have any kind of support staff, salaries, I could have mentioned in the depreciation on equipment related to selling function would go there. Depreciation on equipment related to anything else other than selling would go in the administrative category, and so on. So in this example, it's 420,000 added together. Total operating is 1,065,000. Take the difference, and you'll see I had the line income from operations added here, so 785. Because why? We had other expenses in the form of interest expense, so something that's not part of our main operations, for 25,000. So subtract that to get our net income of 760,000. So just giving you a mild example of when you implement that. So we had something that didn't fit into our operating, definition of our operation, so had to include that extra line and this extra section as a result. So we end up with a net income of 760. If you wanted to turn this into a single step format, could you? Absolutely. The rule is you can always go from complex to simple. If I give you a single step income statement and said, now put together the multi-step, see, that's a lot more work. So that's why this is a better format. If somebody doesn't care about all this stuff being laid out like so be it. They can simplify it on their own. All right, so we already talked about the formulas implied in this one here. We're going to look at the concept of gross margin percentage, which is just simply taking our gross margin divided by our net sales. Right, so in other words, it's just going to be like, what was that margin divided by net sales, and that'll give you what your percentage is. Now, in this case, the analysis I'm going to look at is we're going to look at saying this business in prior periods had a tendency towards a 40% for this. In other words, when they took their gross margin, in other words, when they took this 1,850,000 and divided it by net sales, they would typically get 40%. Obviously, we wouldn't get 40% in this instance. In this case, we would actually get 37% in this case if you do the math on this one. So we get 37% instead of 40%. So serviceable enough. So what happened? Like, why are we not seeing our historic tending toward 40%? Why is it a little bit down from that? Actual margin again was only 1,850,000. We expected it to be 2 million based upon historic practice. So why are we off? Where did that $150,000 discrepancy come from? Right, so the decline, which I'm describing here, there's 3 possible causes. First one's pretty obvious. Rising costs of merchandise purchase. We're paying more for our merchandise. It's costing us more. So therefore, because of that, the cost of the merchandise sold is higher. Therefore, our margin is down as a result of that. This one's also pretty obvious. Reduction in the selling price of goods. We have to charge less for our goods because of competitive factors. Therefore, because that pushes our sales down. So of course, cost of our goods are still X. So as a consequence, we see the margin gets reduced. Number 3 is a little bit more of a soft issue here, as we call it, not a hard numbers issue. We changed vendors, right? So of course, changing vendors means that number 1 happened. Our goods cost more. Right, so it's partially one we just talked about, but again, maybe we save on other down income statement costs such as insurance expense and storage costs. Maybe we have simply it's just a more reliable vendor. In other words, maybe the previous vendor was costing us sales. Right, we ordered something from them because we had a pending sale coming up. Something was arranged. We didn't get the goods on time. We lost that business. So you might be willing to incur the additional cost of the goods because you're not losing sales, or as I also suggested, maybe you have a vendor that's getting you goods like just as you need them, so you don't have to store as much, and because of that, your insurance costs go down as well. Right, the last thing we have to tackle in this chapter, in the merchandising chapter, is adjusting entry changes. Right? There's really just one main change to your adjusting entries here, and that is that because you are dealing with tangible goods, you're going to have to at least once per year. Again, I refer to this as a minimum requirement, meaning if you're a publicly traded company, you got to do this at least once a year. Now, it depends on the nature of your goods, though, how often you should be doing this. Now, I will talk about this because it doesn't matter because the company's not around anymore, but I had a student who worked for Motorola, gone now, and we were talking about this part of doing a physical count. He raised his hand and said, "Hey, we haven't taken inventory in 3 years." And I kind of looked at him like, "How is that possible? You're a publicly traded company. Who was signing off on that audit?" I can't imagine who would allow that. Or if they did, it would be a giant qualification. Oh, and by the way, they're not taking physical inventory, so I don't know what to make of what you're looking at here. It's probably not very accurate, their inventory figure. Now, is it? As you'll see why in a moment. But again, how often you do this depends on the nature of your goods. Like for a lot of companies, once a year is fine, right? The nature of goods is such as, we could just wait and just do a physical count on a once per year basis and everything's fine. But I had a student that worked in a lab, that dealt with, a pharmacological lab, a lot of pills. And I asked her, I said, well, how does your inventory work? And she said, well, most of the time in there, they would take inventory for typically it was I think they did it, I think she said quarterly was how a lot of the stuff in there was done. And of course, it occurred to me, I'm like, okay, but what about something like, let's say, OxyContin or Vicodin? How often do you think they would take inventory, physical count of that? And I'll just let you think about it for a moment. What do you think? How long do you think they would let that go before they would take a physical count? Like a month? That would probably be a bad idea. Every 2 weeks? That's probably not too good. Well, maybe just once a week would be okay. No, still too long. Every day, they took a physical count every day. If they made it a once a week habit, we'll just take a inventory of this once a week. Somebody could walk out the door with stuff that was a street value of potentially in the millions. So because of that exposure, it was very, very controlled environment. Physical count was done every single day because it was so sensitive. So again, this concept really varies. And of course, what you will notice is that the further you are from your last physical count, the greater the drift you will get between the book value of inventory versus what the physical count is. So obviously, if you're counting every day, you would expect the drift to be zero, right? Especially in that type of inventory. It should be every day, it should be count down perfectly. But if you wait, if it's been a year, obviously there's going to be a discrepancy there. Now, your discrepancy between the booked and physical count is usually going to indicate what would be generically labeled as shrinkage, meaning booked value is greater than the physical count. Because here are the things that are going to account for why your inventory has shrunk in the interval. Number one is a pretty obvious one, spoilage. It's counted for, but it's not saleable. It's there, there was a hole in the roof of your storage facility, didn't realize it, a bunch of stuff's been destroyed. Theft, it's just missing. Should be there, not there, we don't know what happened to it, therefore we have to assume that it's been stolen. You might have on your hands obsolescence, meaning it's accounted for. you can account for it, but according to your records, it's well, guess what? This inventory is simply out of date. Let's say you're dealing with computer parts, and you find a bunch of computer parts for computers that nobody even has anymore, right? And they have no legitimate sales value, or maybe a nominal sales value. Like maybe you could get you could get 50 cents a piece for them, but it's well, it's why bother? It's more like we might as well junk it. It's taking up more space than it's worth. It's obsolete. So in other words, there it is, but you just simply need to subtract it because it's really just junk. And then the last one's just the most innocent of the bunch. Oops, mistakes. It was a miscalculation in cost of goods sold, or possibly miscalculation of purchases. So that's why something was a little bit amiss there. All right, so what you're going to do is you're going to take the difference between the booked and physical count, and we're just going to treat it as cost of goods sold. Now, the rule here is this should be immaterial. If this is material, in other words, this is a large amount that has, let's say, been spoiled or gone missing or even obsolete, a mistake probably wouldn't be that much of a big deal. But if it's any of the three, full disclosure principle is going to compel you to at least footnote the value of the shrinkage and obviously the cause of the shrinkage, like why did it go down so much, right? Why did your inventory balance go, again, like a material with respect to the inventory itself. So again, if we're dealing with a $3 million balance and suddenly $500,000 is being written off, you better say, well, what happened? And again, if it's theft, you better be describing why, what you're going to do in the future to mitigate that theft, to prevent it from happening again. All right, so in this example, we'll say Vonnegut's physical count indicated $2.6 million of merchandise on hand, but the balance was $2,640,000. So in other words, we had a $40,000 discrepancy there, $40,000 of shrinkage. So we're just going to flow that through cost of goods sold. So debit that, credit inventory, and then now we have book value and physical count are identical. So that's the purpose of what you're doing here. You're trying to make those two things equal each other. Now in this case, if the whole $40,000 was all due to theft, even though it's not significant with respect to the total amount of inventory, I might still urge a publicly traded company to say, yes, you probably should footnote that all that shrinkage was due to theft. And again, what are you going to do to prevent this from happening in the future? All right, then that concludes the 5th chapter in the textbook. And look for this in future videos to be up if they are not already up. See you later.